Hello, greetings. Welcome to Dividend Blasters. This is our 116th video. Our topic today is NAV erosion strikes again. YieldMax forced to reverse split. If you're an investor, how safe is your income? So I'm going to talk about what happened with YieldMax just a couple days ago with the announcement. I'm going to talk about why they are reverse splitting 12 of their funds. Some of them are very popular ETFs that folks rely on for income, weekly income. So, what does this mean for YieldMax and what does it mean for the investors? That's what I'm going to talk about. First, a little bit of housekeeping. What I say is not financial advice. This video is for information and education and reflects my own opinions, research, and experience as an independent investor for more than 30 years. So, do your own research, due diligence before making any investment decisions. So, 2 days ago, November 15th, YieldMax announced several reverse splits. This is against 12 of their funds. The effective date of the reverse splits will be on November 28th. So, 2 weeks from the announcement date. It's going to be a Friday. So, following this adjustment, shares are going to be trading on a split adjusted basis, starting on either December 1st or December 2nd, depending on which group they fall in. And so, of the 12, really what you're looking at is 7 of them are going to be subject to a 1 to 10 reverse split. 5 will be subject to a 1 to 5 reverse split. So, I've listed the ticker symbols, the names, and the latest closing price as of last Friday, November 14th. I'm going to read just the ticker symbol and the closing price. ULTY, $4.21. CRSH, $3.01. DIPS, $5.30. Fiat, $2.67. AIYY, $1.96. MRNY, $1.51. CONY, $5.20. A lot of these are short option income strategy ETFs. They tend to be a little bit more volatile, and the NAV can fluctuate significantly with these. These are all under $5, with the exception of a couple of them, barely above $5. They're all very low price. And folks, that's really just the result of the NAV erosion that's gone on here. And I'm going to get more into that. So those are the 7 that are going to be subject to a 1 to 10 reverse split. The next group are subject to 1 to 5 reverse split. I'm going to do the same thing here. Tesla, $7.53. Ybit, $7.58. XYZY, $6.95. ABNY, $9.35. OARK, $7.70. These are in a little bit better shape. The prices are a little bit higher. They're all in that above 750. One's above $9. But they're all 12 are in single digits. The second group, it doesn't look like any of these are short income strategy ETFs. So they're going to be a little bit more stable NAV, but still there's going to be significant NAV erosion here. I'm going to get into that and why that has happened. And how am I going to show you that? I'm going to compare a few metrics to make it abundantly clear what you can expect. So I'm showing the same list of ETFs in the same 2 groups. First number is the distribution percentage. The second number is the price return. And these are all trending 12-month metrics, so the last year. The third number is the total return percentage. So what you see here immediately is this. Every single one of the 12 has a negative price return. And it's not like, 1% or 2%. These are all in excess of 25, 50, 75%. They're significant. Now, I will say this. If you're an income investor and you don't really care about growth, you just want to get consistent, repetitive, predictable income, like on a weekly basis, okay, that's fine. I get that. I'd love that. But what you need to be looking for is this. You need to expect, as an investor, that the total return should be at least above 0%. Can't be negative. If it's negative, you have NAV erosion. it could actually, you could still actually have NAV erosion even if it's positive. Um, but you know, so that to me is my advice. You know, and there's ways you can track the NAV, but that itself can be challenging. When you go to publications, you may see NAV percentages being tracked, but there's something called masked NAV erosion, where the publications don't um, pull that out and show you what the true NAV is. It can be actually very difficult to measure. And what is masked NAV erosion? Um, the NAV goes down because uh, the assets of the underlying fund go down because they've had to be sold to pay out a high distribution. But investors will drip back in, or you have new investors and they're pouring money back in. So it's pushing the NAV back up. But that really tends to be a temporary phenomenon, and it doesn't really address a long term structural problem. And the structural problem is this: the options strategy is problematic because what's happening here is the team is selling options, and they're selling, let's say, call options, where they are basically setting a strike in the with the objective of collecting an options premium. They're going to set these strikes. I know how these guys work. Very close in the money as possible, because they want to maximize how much premium they can collect and pass it on to their investors. If they got a very high target, or they're expected to deliver, you know, 134% distribution, or let's just say, 50%, those are very high. They need to be able to generate enough premiums to cover that. The problem is this: more than likely, the premiums are not going to be enough. The option contract that they've sold, the option against, is going to be assigned, and those shares are going to be sold. So let's say you're at a bull market, and the underlying assets of an options contract uh, continue to go up, but you've sold at the strike price, and so you've missed any additional upside. So any of that price appreciation that's going on in the market, you've missed. And what else have you missed? You've missed the opportunity to grow the fund. Okay, and the NAV, essentially the net asset value of the fund. Uh, so it's stuck, and it's actually going to go down because even though you've sold the shares at the strike, you've missed out. And then you've discovered, oh, guess what? We have to pay out this distribution. We don't have enough premiums from the options trade. We need to sell more of the assets. We need to sell more shares. Okay, we need to get the cash so we can meet that weekly distribution. And so the NAV shrinks even more. And so that's the structural problem. Now, when I talk about mass NAV erosion, uh, if you're an investor and you get that distribution and you're not checking these things, you think, okay, I got the same distribution as last week. I'm just going to pump it back in, and continue to grow my holdings. The problem is your holdings are smaller. So the price per share, the NAV per share has gone down. You're pouring more money in to push it up. But that, I promise you, is a very temporary phenomenon. They can't keep this up because you're shrinking the NAV. And ultimately, you're not going to have enough NAV to generate options premiums or pay out distributions against. It's kind of a um, it's it's a vicious circle, if you will, or a cycle, whatever you want to call it. It's not good. Now, what you see here is most of these have negative price returns. Most of them have negative total returns. So that's the second and the third number in parentheses. But again, what you absolutely should demand from an ETF is to have at least a positive um, total return. Now, me, I want a significant total return. I want, for me in my world, what I like, I want to see uh, growth in the fund. I want price growth, but I also want a growing total return. So any distribution that's paid out, I want it covered by the options premiums that are collected through the options trades. That's what I want. I don't want them, diluting assets or selling shares to meet that. I would rather forego that distribution, and I get my distributions elsewhere. That's me personally. But my objective here is to share with you the inner mechanics of how these things work, so you can basically say, hey, um, maybe this is not the right approach for me. Maybe I need to be a little bit more wary of a firm that has really high distributions, and has negative price return or negative total return. Now, there are a few of these that actually have a decent total return. So Tesla, 24%, OARK 26%, and their share prices are a little bit higher. They're only going to go through a 1 through 5 reverse split. But those distribution percentages are pretty high. So my question to them would be, can you sustain this? And I'm not trying to get negative on all of these funds. I'm looking for the good where I can find it. But to me, the good is, and I'll just say this: I own a couple of income ETFs that pay a distribution of 40 and 50%. But why do I invest in that? Because the total return is 90%. Uh, the price return is significant, so it's growing, and I am confident that the distribution that's being paid out on a monthly or a weekly basis is covered by those options premiums. I'm very comfortable in the fact that they're not diluting or selling off assets. So that's really the landscape here. So these are the 12, and I'm looking at total return. I'm also looking at price return, and of course the distribution percentage. Now, how does this affect you as an investor? Let's say you say, okay, yeah, I get it. Okay, what does this mean for me with my distributions? Well, let's take a look over the last year to date. There's been a precipitous decline. Now, the first three at the very bottom, this is Alti or ULTY. These were monthly. This was a monthly paying ETF, but then in March they became weekly. So you could take the weekly and you could average them, or you could just take that first weekly and say, hey, let's just multiply that by 4. 0.1025, multiply that by 4, that's 41 cents. So if I want to compare that to the previous 3 months, that's a decline. The previous month was 46.5%. Previous month before that was 53.69% or cents. I'm sorry. The one before that was 57.15 cents. So already we've seen a precipitous decline, and yet YieldMax with the Alti fund has decided to go weekly. But you see here that they cannot maintain the same level of distribution. It's gone down. Went down to 0.097, then 0.0986, then 0.091, and then you're into the 0.08 cents. And it went back up a little bit, but then you're back into the 0.08, 0.09, and I'm just going up here. And then look what happens in July 17th. All of a sudden, it's 0.10. So it went up a little bit. Okay, that was a little bit of a good sign. But again, it's much less than it was when it was monthly. If you're to multiply that by 4 and get a monthly estimate, and then you're back into the 0.09s and the 0.09s and the 0.08s. And now, guess what? The last one, 0.0626. The one before that, 0.0788. So the trend here is downward. So if you are, an investor, let's say you're dripping back in, you're going to be dripping back in a smaller amount because the distributions are going to get less. Um, you may see a slow decline in your weekly payouts, but it's going to become more pronounced because it's gravity. You can't beat it. The NAV is shrinking. The overall assets that these uh, options are being generated against and the distributions are being generated against are getting smaller. And so ultimately, if they're trying to maintain uh, about the same percent, they're not going to be able to increase it. Not likely. Maybe they can increase it, but it's going to be against a smaller base. So what you get weekly will be less, and that is really unfortunate. So what's going to be the immediate impact if you're an investor? You're going to see your share count be reduced according to the split ratio. So if you own 10 shares of Alti, all of a sudden you have 1 share of Alti. If Alti was trading, and I think it was, around, what was it, like $4 or $5 a share, all of a sudden it's $40 or $50 a share, but you only have 1 share. your investment dollar amount will be unchanged. Okay, that's not going to change. If you had $50 invested in Alti before the risk adjusted split, you're still going to have $50. But that's just going to be in the immediate aftermath. My concern would be that you may see a reduction in inflows into the fund by investors. Investors may stop dripping. They may say, hey, listen, you did a reverse split. I'm selling my shares. This may affect institutional investors. May say, hey, listen, what's going on here? You guys don't have a stable NAV. I'm not going to, invest in this because I don't want to lose money for my investors. Um, so, you're going to see that immediate rise in the price per share or the NAV per share, but it's really an optics thing. It's a math fix. You're not really addressing a structural problem. The structural problem is this: they're selling options too close in the money, and they're taking on too much risk. These options are being assigned. They're missing upside. They're capping their upside, and then they're realizing, hey, we have to pay out our distributions. Our options premiums are not sufficient because our fund is decreasing. The premiums are decreasing. We need to dilute some of the shares in the NAV that we have left to raise the cash. And that accelerates the NAV erosion. So why does YieldMax do this? They're doing this. It's a defensive maneuver. It's really to prevent any potential delisting. Becoming like trading over the counter or like a penny stock. They're trying to maintain credibility. And they're navigating very difficult waters, as are the investors. So, what's the significance of this? It's basically when you have a low share price, it's abundantly clear that there's consistent NAV erosion. It's because of as I mentioned, the high yield strategy. They're paying out high yield, but also it's those call options. They're selling them. They're a little too aggressive. So they're aggressive in their distribution. They're also aggressive in their options strategy. Um, I already mentioned that the actual value of your investment, if you're a YieldMax investor, is going to be unchanged in the immediate aftermath. But there could be um, a degradation in the price as investors may start to pull out. So why do these happen? And I think I've hit this pretty hard. When the price of the share drops to a very low price, there's something called a delisting threshold, which typically approaches about $5 a share or less. So we saw that several of these were less than $5. So there's a risk of delisting. So the YieldMax folks really had to do this. They had no choice. And I mentioned that this is a structural issue. It's the natural effect of high distribution yields, and we saw them. We saw Alti, I think it was 134%, which is huge. Um, and then the strategies, which are a little too aggressive. They're capping that upside. They're selling those options a little too close in the money. And basically, they cap the upside. They can't collect enough premiums. And then they're having to pay out more distributions. So temporarily, this helps YieldMax. It helps avoid uh, any reputational risk, although I think it is going to be significant. But they're not delisted. They're not a penny stock fund. But can we promise that doesn't happen? No, there's a risk there, certainly. I mean, these reverse splits are perceived in a very negative way to investors, retail investors, but also to institutional investors. Its significance, persistent NAV erosion, and it really raises concern. Is this sustainable? I mean, are they going to change their strategy? Is the option strategy going to change? Are they going to pull back a little bit and try to preserve some of the NAV? Are they going to reduce the distribution percentages? We saw, Alti, for instance, I think it was 134%. It's really a lot. Um, and so, you may be able to do one or the other, a high distribution yield, or you can have an aggressive uh, options strategy where you're selling very close in the money. You really can't do both. You may be able to do both if your price growth is huge, if it's really, really, really significant, and you can, get away with that. But that's not always the case, and you have to have that flexibility. You can't say, "Hey, we're gonna distribute 125% every week, no matter what," because they box themselves in, and you get NAV erosion, and here's where you are today. Um, So what could follow this reverse split? As I mentioned, the share price will go up, the NAV will go up, you know, in the short term aftermath. But historically, um, the price and the NAV is going to go down. It's going to drift down essentially because of if they don't change their strategy, but also investors are going to get a little bit spooked and they're going to start to pull out. And I would say this that I've done some reading on this a little bit and researching, and my thought is, hey, listen, are they committed to changing their strategy? There's been no announcement they're going to do that. Now, maybe they will do that. Maybe they're going to change their strategy to try to preserve the NAV, but we've seen no evidence of that. So, what are the key points for the investors? This reverse split is a warning sign that the option strategy is wearing down the NAV in an accelerated fashion. Um, this reverse split is a math fix. It's cosmetic. It's not a plan. It's not a get well plan. It's basically saying, "Yep, we're going to go ahead and restore the NAV, restore the price," but they're really not, and there's significant structural issues here with their model, their business model, and it doesn't really work. If I'm an investor and I'm not ready to sell yet, I'm going to be looking for signs of ongoing NAV erosion. Are the assets under management shrinking? Are outflows significant? Are outflows outpacing inflows? Is the dividend, is it being maintained or is it shrinking? So I'd be looking at things like that. Um, so so the skinny is this reverse splits. They don't fix NAV erosion. As I mentioned, it's a math fix. It's cosmetic looking. It provides temporary stability to the price. And also eligibility for margin in institutional investors. Um, it avoids delisting, essentially. If you're an investor, you need to look out for things to um, check the model, look at the risks, look at the long term sustainability. Hey, you need to ask yourself some questions. What is my risk tolerance to continue to invest in this or to hold this even? Should I start to look at other ETFs and look at the effective yield? Personally, if I want that high yield, I want to see a underlying asset that has huge price appreciation. I don't want to see price degradation. I want confidence that there is no real evidence of NAV erosion. Um, I'm going to be looking at the payout trends or the distributions. Are they steady or are they growing? The total return, is it positive? I want to see at least a positive total return. And most importantly, I'm going to be flexible. I need to be ready to exit my holdings if I feel that this no longer works for me. Folks, that is it. I hope you found this video to be informative and useful. And if you did, I'd appreciate it if you give us a like, share the video with a friend, hit that notification bell. So when we release another video, and we would love, love, love for you to subscribe to our channel. It's a great help to me to maintain this channel. I'm also on different platforms. I am on X, I am on Instagram, and I am on Facebook. You can see my QR codes and my handles. And if you've listened to me before, you know that I am a affiliate partner as well as a long time subscriber to Seeking Alpha. I think it's a wonderful, it's the best online digital publication there is, and I read it all the time, and I depend on it. I love the premium, which gives me access to up to date stock quotes, ETF quotes, and insightful analysis. Um, we can offer a 7-day free trial and 20% off the intro price for the first year. Um, Check out the link below and the QR code to read more about that deal. This is part of the Black Friday sale, and it just started on the 12th of November. It's going to go to December 10th for this offer. Same for Alpha Picks. This is a little bit different, also by Seeking Alpha, where you get 2 new stock picks every single month, and it's chosen by their quant system, and it's curated by their subject matter expert analysis team. And I also subscribe to Alpha Picks. The picks are wonderful. They uh, perform really well against the S&P 500. A lot of them perform better. So this is a little bit different than the premium. This is a little bit extra. I like it. You can see the link below and the QR code. You get 20% off that first year intro subscription. And if you want to get them both, get the bundle. I'm kind of like a bundle owner, essentially. I get them both. You can see that Premium Alpha Picks, it's about $574 for both for that first year. Normally it's $798. So you're going to save over $200 for that first year if you want to get Premium and Alpha Picks. The link is below, as well as the QR code. I'm going to also put these in the comments so you can just click on the hyperlink and go right to it, or you can just select the QR code and go right to it. And as I mentioned, I am on different platforms, so check me out. And we thank you from Dividend Blasters for listening to this video. Have a wonderful, wonderful day. Until our next video, God bless.